Welcome, everyone. Welcome to today's webinar on the financial benefits of going green. We'll focus on the energy investment tax credit and the powerful incentive that was designed to drive renewable energy adoption and to reduce costs for businesses and organizations. So in this webinar, we're going to focus on key eligibility requirements and practical steps to leverage these effectively. This webinar will be most beneficial for our business owners and organizations who are installing renewable energy technology or are looking to install renewable energy technology, our engineers and contractors who focus on serving those businesses, and then our investors who are seeking insights on financial returns and sustainability benefits from renewable energy projects. So our goal in this is to help you. So take the most of this opportunity, ask any questions. We're going to provide you with an overview and address any questions you may have. So to start with us, my name is Andrew. I'm an engineer by background. Been in the specialty tax world for under a decade. And over my career, I've conducted over 800 different energy studies and helped uncover over $50 million in incentives for small to medium-sized businesses. Also a licensed IRS enrolled agent, so help taxpayers as well, representing them before the IRS up to appeals. And I'll pass it over to Savanah for an introduction.
Hi, everyone. Welcome. Thank you so much for joining. So my name is Savanah Durham. I am a senior technical consultant here at Leyton and assistant team lead. My background is in chemical engineering, and I've worked in the tax space for coming up on 5 years now. I help companies claim multiple specialty tax credits around clean energy as well as research and development. So I'm looking forward to presenting to you all today.
So a little bit about Leyton. So Leyton is a global consulting firm that specializes in financial incentives. Founded in 1997 and currently headquartered in France, Leyton operates in 20 different countries, including the US. We have about 50,000 clients, 3,000 employees. And in the US, specifically the Boston and San Francisco office, we are focused on providing those tax incentives that are extremely complex, convoluted, often too complex for the traditional CPA to handle or navigate, or that require some tax expertise where engineers that want to assist may recuse themselves from assisting the taxpayers that are entitled to these credits or deductions. So our mission is to bridge the gap to ensure that clients are maximizing their financial incentives while obviously staying within the letter of the law. We collaborate with reputable CPA firms, and we're well positioned to assist business owners, organizations, CFOs, and developers navigate all of the complexities with tax incentives. So from a specialty tax perspective, I wanted to show the CRE or commercial real estate incentives. So a brief overview on these four that fit well together are the 45L residential energy efficiency tax credit. This helps developers earn $5,000 per unit. The 179D energy efficient commercial building deduction is for commercial renovations or commercial new builds. A great way to offset tax by way of an immediate depreciation deduction. You can get up to $5.65 per square foot in the year 2024, given the renovations and upgrades made. It requires an energy model as well as a licensed professional engineer to step foot on site and verify all the energy efficient commercial building that's been placed into service. Cost segregation is a very good service that goes hand in hand in real estate. What we do is we reclassify components to help accelerate that building's class life. Beyond a 39-year, we typically see a lot of 15-year assets that go overlooked. So putting more money back in your pocket by helping unlock that cash flow by way of immediate depreciation deductions. Then the 48 credit, which we'll spend a lot of time on today, which aims to support those energy efficient investments, but you can get 30 to up to 70% of your eligible project basis. So excited to cover that today, and we'll walk through the agenda. All right, so a quick look. We'll start with an overview and background. Then we'll move into section 48. We'll talk about the sunset of that and how things transition into section 48E for renewable energy electricity generating technology. We'll also touch on bonuses and how they enhance that incentive. And then we'll discuss the credit utilization process as well, how you can monetize that benefit, get a cash payment back, or utilize it on your own taxes. And then we'll stop at the Leyton's process and how we can better help you and serve your business or organization.
So starting just with some brief background and overview into the energy credit and then the clean electricity credit. The energy credit, which is IRC Section 48, was initially created to help companies ease the burden of investing into renewable energy sources. They included fuel cells, solar, geothermal, small wind, energy storage, and a lot of other technologies that are enumerated in the tax code. And then we'll talk about IRC Section 48E, which is the Clean Electricity Investment Credit. And this is also designed to promote investment in clean energy, but it's specifically towards clean electricity generation. And it will replace IRC Section 48 for things that are placed in service after 12/31/2024. It's important to note that the Section 48E credit is technology neutral, which it really encourages a broad range of technologies as opposed to Section 48, which had an enumerated list of technologies in the tax code. Originally, this tax credit 48 was introduced, the investment tax credit, in 1962, and the current regulations were last updated in 1987. As I already mentioned, it was really intended to stimulate the adoption of clean energy by reducing that burden on investors and developers. Now, as I'm sure you all have heard a lot about this, but the Inflation Reduction Act in 2022 added newer technologies such as energy storage and qualified biogas property. And then it also transformed IRC Section 48 into IRC Section 48E for facilities beginning construction and placed in service after 12/31/2024. So just after the end of this year. The IRA also introduced some new prevailing wage and apprenticeship requirements, introduced new bonus tax credits that enable taxpayers to increase the value of their investment tax credit, and it enabled several methodologies for actual utilization of these tax credits, including transfer and direct pay.
All right, now we're going to talk through Section 48 first. So when looking at Section 48, we want to start with who is eligible. So who's eligible depends on who has basis in the property, who has purchased these systems, or who has ownership interest in these systems. So what that looks like is if you have an eligible basis that includes, labor cost, material cost, or other allocable expenses such as mobilization, equipment rentals, permitting fees, or engineering services, then you're likely entitled to the investment tax credit. So as long as it was constructed or reconstructed with you, or it was acquired. The main key takeaway here is that the energy property needs to be new. So when you're acquiring this property, it has to be originally used. Now, the type of equipment that is eligible, or what we'll deem an energy property, is a specific list that Savanah mentioned. the next slide will cover this in detail, but these properties will need to meet performance and quality standards set by the Treasury. They worked with the DOE to develop this list since, I believe, 1978, where depending on where the country's headed, the administration is headed, certain technologies have been either added or switched out. And the IRS or the Congress has consulted with the DOE in the past to make sure that we as a nation are incentivizing the right types of technology. So you'll see a couple of swaps of certain systems in prior years if you were to take a look back, or certain swaps in systems when you take a look forward. So it's important to note that whenever you are dealing with investments and you're looking at technology, that you're using a tax professional to make sure that you are eligible in a relevant year. And the other requirements, which is the property must be depreciable and amortizable. It has to be a unit of energy property, which we'll get into as well. It has to be integral to the energy property. And there's a couple of other expenses that may be included depending on the facts and circumstances, often with dual use property and incremental cost. So when you're eligible, I touched on it a little bit, but it depends on the year that your property is placed in service. So what that means is when your property is ready for use, and this could be hinged on a couple of factors. Some things that we look at are obviously going to be permits, when your system was commissioned, if pre-operational tests were completed, and maybe there's a permission to operate or even a certificate of occupancy. So depending on the facts and circumstances, that timing of your building being placed into service also hinges the timing in which you can take advantage of the benefit within a particular taxable year. So this is a list of energy properties. You'll see that energy storage has now been included since 2022 IRA. There's also a couple of sleeper systems in here that I like to say. Electrochromic glass is often one that is I'm seeing a bit more often in real estate, where a lot of owners are not or just not aware that this has now been added since the IRA. Geothermal heat pumps as well. You wouldn't believe a lot of owners would install geothermal heat pumps to take advantage of, utility, local rebates, state incentives, not knowing that the 48 ITC, even pre-2023, there is available benefit there. I believe in tax years 2021 and 2022, the benefit there is a 10% credit, as well as a 5-year maker accelerated, a 5-year maker reclassification due to it being energy property. And when you look at section 168K, or when you look at the provisions set forth from TCJA, that could mean immediate depreciation or bonus depreciation there. So definitely worth taking a look at and getting with the tax professional if you think that you have a system that you didn't get benefit for in a prior open tax year. We can definitely take a look for you to make sure that you are maximizing your value there. So what is a unit of energy property? So this is out of the Treasury regulations and supporting tax code. A unit of energy property is functionally interdependent components that are owned by the taxpayer that operate together and can function independently from any other energy properties that are in a larger project. So in this webinar, we're going to keep it simple. We're going to focus on solar examples. So within a solar system, what that definition means is your solar panels, inverters, and wires that must work together to generate and transmit energy are functionally interdependent. So all components installed on the same rooftop from a single or all components that are installed on the same rooftop, they form a single unit of energy property. Integral property, that is property that is used directly in an energy property's intended function and is essential to its completeness. So the integral property supports the energy, but it does not need to depend on any other components to operate. It's also owned by the same taxpayer. There's a couple of rules and regulations around this that I believe released in the most recent proposed regulations where some integral property actually may be off the table if it's not directly owned by the taxpayer. But we have situations where there is joint ownership, and depending on these two different tests of functional independent components and integral components, certain exclusions are necessary. So an example there on integral property is a transformer that steps up voltage for grid transmission is an integral part of energy property. That's power conditioning equipment that does include switches, and you have transfer equipment as well. So certain cables or some equipment that is either in front of the meter that may be disqualified depending on the ownership there. So how do you calculate the base credit? So we've talked through the cost. Now let's talk through the actual credit. The credit can either be 6% of the eligible basis we talked through or 30%. So yes, that is a 5x multiplier, and this comes out of the IRA. And the way that we can get to that 5x multiplier is going to be dependent on one, construction. If construction happened prior to January 29th of 2023, you're immediately eligible for a 30% base. Now, also, if it's under 1 megawatt, projects that are under 1 megawatt automatically qualify for this as well. And in the event that those first two conditions aren't met, we would then look to the prevailing wage and apprenticeship requirements, where projects that began construction after Jan 2023 must meet certain wage and labor requirements. So in general, I know this is a lot of information, and we'll leave you all with a video recorded on YouTube, but at a high level, workers must be paid at least the local prevailing wage rate for similar work as determined by the Department of Labor. So you can find these rates on sam.gov. From an apprenticeship standpoint, you need to meet certain labor hours have to be from an apprentice. So that's 10% in 2023, 12.5% in 2024, and it steps up to 15% in 2025 and beyond. And this is applicable for any subcontractors or contractors that are on the relevant project. So projects that are under 1 megawatt, they don't require prevailing wage, but for the ones that do, there is a non-compliance requirement too. The penalties are $5,000 to $10,000 per unpaid worker. So triple check to make sure that you are in compliance. It is a heavy penalty, and our team can definitely help sort that out and make sure that you're good to go from a compliance standpoint. So again, here, sticking with a very simple example, we have a solar PV system. We wanted to walk you through the mechanics of the tax credit. This won't include depreciation for simplicity. We'll just talk through some of the eligible components and what that potential could look like just with a 30% base. So you have direct and indirect expenses here, labor, fees, permits, the price of the equipment, taxes. So this total basis equates to $2 million in this example. You're able to get back a 30% tax credit. So that's $600,000 savings on the credit side alone.
Awesome. Thank you so much, Andrew. So we're running up against time, and I want to leave some room for questions. So I'm going to kind of quickly go through these slides, but as was already mentioned, we'll make these available to everyone. So as I already mentioned, the Inflation Reduction Act has transitioned into Section 48 into 48E. So from the energy credit to the clean electricity generation investment tax credit for projects that started after 12/31/2024. So I'm going to go into a little bit of detail on some of the major changes of the tax credit and what you guys can expect to see for future projects. So one major change is, I guess it kind of seems minor, but for tax professionals, it's very major, is terminology that's used in the tax credit. So Section 48 used to use energy property, whereas Section 48E is now using qualified facilities, energy storage technology, and interconnection property. So the energy storage technology and interconnection property are the same definitions as used under 48, but qualified facilities is also used under Section 45. But the energy storage technology, like thermal, electric, and hydrogen, it has to have an electrical capacity of at least 5 kilowatt hours. The most significant change that I'll talk a little more about is that Section 48E is what's called a technology neutral tax credit. And that means that any not greater than zero is potentially eligible. Now, the IRS released kind of a categorically qualified list of electricity technology, such as wind, hydropower, solar, geothermal, nuclear, and waste energy recovery, as those always have zero greenhouse gas emissions. Now, another major change is specifically for combustion or gasification facilities, or CNG facilities. Because these are not already predetermined to have zero or less than zero greenhouse gas emissions, taxpayers will actually have to calculate and determine the greenhouse gas emissions using a life cycle analysis. So it's important to note that for 48E, the CNG facilities, if you're looking to qualify them, they have to be related to the production of electricity. And then finally, 48E will disqualify several of those technologies that actually Andrew touched upon. So if you installed those over the past couple of years, go ahead and get in front of it, because microgrid controllers and electrochromic glass will generally not qualify under Section 48E. And again, that's if construction begins after 2024. This just briefly reiterates those, the criteria that are required to qualify for 48Es. So the facility has to be used for the generation of electricity. It has to have zero greenhouse gas emissions or less. And the facility must be placed in service after December 31st, 2024. And then there's just a list of a few examples of technology that I've briefly touched upon. So diving a little bit into the greenhouse gas emissions rate, as I said, there's a list of already pre-qualified facilities that will meet the 48E standard. And that is, again, just that the greenhouse gas emissions have to be zero or less. However, if the facility that you've installed does not fall within that pre-qualified list, the IRS has said it will publish an annual table listing emissions rates for different types of facilities. So if your facility aligns with something on that table, then you can use it as substantiation that your facility complies with the requirement. Now, in the case that you have a facility that doesn't fall into that table, you will actually need to calculate the greenhouse gas emissions rate using provisional emissions rates, or PER. And this can be determined either by the Department of Energy or a life cycle analysis model of the facility. And taxpayers have to file this within their return, essentially certifying that the technology is greenhouse gas neutral. Just some key considerations, as already mentioned. Make sure your facility is eligible. Make sure that it meets the emission standards. Make sure that you have an accurate base calculation and you're including all eligible costs, purchase price, construction, installation, etc. It's important that you maintain documentation so that to be compliant with prevailing wage and emission requirements. And then be aware of the place in service requirement for claiming 48E, as well as the timing of various prevailing wage and apprenticeship requirements. Now, the bonus credits that the IRA introduced can really add a lot of value to the investment tax credit. So this chart kind of shows all of these bonuses that are example, but it starts at 6%. And then if you meet prevailing wage or less than 1 megawatt, that can be up to 30%. If you get the domestic content bonus or the energy community bonus, those are both 10% addition. And then the low income or tribal land is a 10% addition, or a low income project or economic benefit project can get you 20%. So your max credit is 70%. Now, these low income related bonuses are only available for electricity producing, and you have to get an application before the asset is actually placed in service. So the domestic content, we just want to make sure that all of the steel and iron used in the project are sourced domestically, and that 40% of manufactured components are produced domestically. This will increase after 2027. And the key requirement is that you must certify and submit a certification statement that all of these materials meet the requirements. And that can be very difficult to retro. Someone who's going to be able to perform this analysis and get all of that information for the certification statement from the get-go. The energy community bonus includes a 10% adder if you're in a brownfield category, a statistical area, or a coal closure category. And the statistical area category and coal closure category can be found on the Department of Energy website. They have a really nice interactive map. And the brownfield sites, if you're building in a brownfield site, you more than likely know it. But there's obviously information on that available as well. Then this is some detail on the low income bonuses. I'm not going to go too in depth on these, but if you're in a low income community, if you're on Indian land, if you're building a project related to low income, then you're going to be able to claim an additional credit with the investment tax credit. So how do you actually realize these? I'm going to have Andrew touch on that maybe. It looks like we're running up on time.
Mm-hmm. So really quick, there is 3 ways to utilize your credit, and the scenario is going to be a for-profit owner that has sufficient tax liability. They'd be able to directly apply this to their tax return. I left some of the operating rules here for you to understand or digest for your particular scenario. The transferability, if you're a for-profit, and in the event you don't have tax liability, you can actually put this on the market. You just need to find an unrelated taxpayer, create a deal, and you can file a transfer election essentially, you can elect to transfer your tax payment. And then thirdly, if you are a nonprofit, you can actually get a tax payment back from the IRS for your energy property claim. So in all 3 scenarios, we service you all to make sure that you're able to maximize that incentive, but also use it, right? That's why we're all here as well, on top of supporting sustainability needs. I'll go over the Leyton process really quick, and if there is time for questions, definitely would love to address them. So upon letter of engagement, we will schedule a kickoff call with you, explain the process, the timelines, expectations on our side, as well as identify the relevant key players that we'll work with. After that call, we'll send a tailored information request where we'll start getting information, and this is where the project and the backbone kind of comes to life with where the credit is going to head, what type of bonuses that we're going after. The feasibility is where after we've gotten an idea of the applicable bonuses, this is something that we'll try to wrap up, get to shore up. So if that's domestic content bonus, if that's the low income community bonus that you could apply for, or maybe a brownfield analysis that needed to take place to see if you can get the energy community bonus, that's all work that we do. We do all the heavy lifting, but we want to make sure that your credit again is maximized. We'll then go into a 3-tier review process with our tax attorneys, our engineers, our CPAs to make sure that everything is included in our financial analysis, and we will then deliver. So the delivery looks like a hardbound delivery that memorializes all of the work that we did. It'll showcase everything from why you're an eligible taxpayer all the way to the why that dollar amount is the dollar amount that you are able to file. We do also provide the forms that you need. We assist with helping you find a method for filing. So that's really where Leyton ends in the process. We also help with transferability too, and as well as assurance. So if you have any questions regarding transferability, the third party market, or identifying your tax credit, we're here to help.
So I know we're a bit over. We will be sharing a link to book a meeting or send us an email with any questions that you all have. But we can also hang out here for a few minutes just in case anyone has any more questions. Thank you so much for joining.
Will we be doing a similar session on the use of geothermal systems? Jim, that is actually a very good suggestion. I believe sometimes next year we're going to get component specific and provide all the guidance or detail that one may need to know if they're looking at a geothermal heat pump system for an investment and how that could play into their tax situation.
All right, everyone. Well, as I said, please reach out to us if you have any questions. We're always happy to hop on a call, and we will be sending out some information to those who attended. And we appreciate everyone's time. Thank you so much, you all, for joining.
Thank you, guys.